If you were living in the United States during the 90s, you may have heard of Enron. It was the star of Wall Street, named America's most innovative company 5 years in a row. They had a 50-story skyscraper in Houston, hired the brightest minds in the country, and could make anything sound like a business opportunity, even the weather. But it wasn't always like that. To understand how they reached such heights, we first need to go back to a time when things were far less certain. It's 1985. Two natural gas companies, Houston Natural Gas and Internorth, decide to merge. The industry was changing fast. The government had started deregulating natural gas prices, and chaos followed. Old contracts no longer worked, and companies were drowning in debt. The traditional pipeline business was becoming obsolete, and that's when our first key player enters the story. Kenneth Lay, an economist with a cold and ambitious vision, he would take the helm of the new company. Lay understood the game had changed. It was no longer just about moving gas through pipelines. Something more was needed, something that would make Enron not just survive, but dominate. And that something came in the form of a young McKinsey consultant named Jeffrey Skilling. Skilling had a revolutionary idea. Why not treat natural gas like money? Why not create a gas bank? A place where producers and consumers could sign long-term contracts, and Enron would take a cut as the middleman. Lay listened, and he loved it. That's how Enron Gas Services was born, and very quickly, it would change the game entirely. But that was only the beginning. In the years that followed, Enron wouldn't just sell gas. It would sell electricity, coal, paper, insurance, even the weather. They became experts at creating markets out of thin air. And every time something seemed worthless, Enron found a way to make money from it. Now, all of this looked great on paper, but there was a small detail. The real profits weren't as big as they appeared. So in 1991, Skilling convinced the audit committee to adopt a creative accounting method. It was called mark-to-market accounting. Basically, Enron could sign a 10-year contract, estimate how much it might earn, and record that entire amount as immediate income, even if the money didn't exist yet. Legal? Technically, yes. Dangerous? Absolutely. With Lay at the top, Skilling running the business, and a rising finance star, Andrew Fastow, a young CFO with a knack for designing almost incomprehensible financial structures, Enron became a giant, a sleek monster that appeared to generate money out of nothing. But in business, like in magic, not everything that shines is gold. And in this case, the illusion wouldn't last forever, because what was coming next wasn't growth, it was collapse. By the year 2000, Enron seemed unstoppable. They were executing $2.5 billion in transactions every day. Their platform, Enron Online, was a tech beast, operating like a private stock exchange. And their value on Wall Street, it was skyrocketing. Shares hit over $90 each. Any analyst who doubted them got left behind. No one wanted to be the fool who missed the next financial miracle. But behind the scenes, it was all smoke. You see, to keep up the illusion that Enron was constantly growing, accounting tricks weren't enough. Skilling and Fastow began playing a far more dangerous game. They started creating ghost companies. They were called SPEs, special purpose entities, and they were like little black holes where they dumped failed projects, unpaid debts, and anything that could tarnish the company's books. Many of these entities were controlled by Fastow himself, Enron's CFO. He was both the architect and the beneficiary. He designed the schemes and then profited from them directly, pocketing millions in the process. Meanwhile, Lay and Skilling kept selling the dream. They talked about expanding to India, Africa, the future of fiber optic telecom. They even invested in a high-speed internet business they barely understood, all just to keep up the narrative that Enron was the company of tomorrow. Financial statements were bloated with fictional numbers, losses were buried, and every time a project collapsed, they'd create a new SPE to cover the mess. It became a chain of lies propped up by greed and fear. And to make sure nothing went wrong, they needed an accomplice. They found it in Arthur Andersen, one of the most prestigious auditing firms in the world. Officially, their job was to review Enron's books. In reality, they were part of the act. For millions in consulting fees, Andersen looked the other way, or worse, helped build the smoke and mirrors. All of this worked while the market was booming. But when the tech bubble burst and the economy slowed down, Enron began to wobble. And then came a critical moment. In February 2001, Jeffrey Skilling was named CEO. Lay became chairman of the board. But something was off. Just 6 months later, in August, Skilling suddenly resigned, citing personal reasons. The public didn't know what to think. Shares had already dropped to $30, and rumors were swirling. Some insiders began to notice things weren't adding up. One of them was Sharon Watkins, a vice president at Enron, who wrote an anonymous memo warning that what Fasto was doing with the SPEs could be fraudulent. By then, it was already too late. In October 2001, Enron announced a $638 million loss and a $1.2 billion reduction in shareholder equity directly linked to Fasto's entities. Panic spread. Shares plummeted to under $12. Analysts started digging deeper, and the SEC launched a formal investigation. And as prosecutors arrived with court orders, Arthur Andersen employees began shredding documents. Enron's collapse wouldn't just be the fall of a company. It would be the ruin of thousands of families, the end of careers, and the beginning of the largest corporate scandal in modern U.S. history. Enron's offices in Houston were no longer symbols of success. They were pressure cookers, confused employees, vanished executives, furious investors. The stock, which just a year earlier had been worth over $90, was now trading for less than $1. And in the middle of it all, one last hope: a merger with Dynegy, another energy company. Lay pitched it as a lifeline. But just weeks later, Dynegy backed out. They had seen the real numbers and realized what no one wanted to admit. Enron was rotten to the core. On December 2nd, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in U.S. history. Thousands of employees were left jobless. Others watched their retirement plans, their 401ks, vanish. Why? Because most of their savings were tied up in Enron stock that was now worthless. That same month, the FBI, IRS, SEC, and the Department of Justice joined forces to create the Enron Task Force. What they uncovered was a web of deceit so complex it would take more than 5 years to fully untangle. Hundreds of agents, over 3,000 boxes of evidence, more than 4 terabytes of digital data. Every file, every email, every spreadsheet told a story. But the investigation didn't just uncover financial crimes. It also exposed shady dealings with foreign governments, rigged contracts, international bribes, and schemes to inflate asset values that simply did not exist. They even sold overpriced electricity during California's energy crisis, stealing millions from taxpayers. This wasn't just fraud. It was a corporate culture built on abuse and a total disregard for ethics. After the collapse, what followed wasn't just an investigation. It was a hunt. The Enron Task Force wasn't there to play games. They interrogated more than 1,800 people, processed thousands of emails, tracked bank accounts, froze assets, and uncovered one undeniable truth. Enron was a fraud machine, run from the very top. One by one, the executives started to fall. Some negotiated, others tried to fight back. But in the end, 22 people were convicted for their roles in the scandal. Among them were names that once symbolized corporate power. Andrew Fastow, the financial genius behind the SPE schemes, pleaded guilty in 2006. He was sentenced to 6 years in prison. His fortune? Largely confiscated. Over $105 million was recovered to compensate victims. But for thousands of employees and shareholders, it wasn't enough. Shortly after his release from prison on December 16, 2011, he began working as a document review clerk for the law firm Smyser Kaplan Veselka LLP in Houston. Since his release, Fastow has worked the public speaking circuit with presentations on ethics in business. In one such speech, Fastow recounts his crimes at Enron and reflects on his culpability. Fastow became a director and investor in Keen Corp in 2016. Keen Corp is a Netherlands-based company that offers analytics and artificial intelligence products that monitor daily workflow, emails, Microsoft Teams chats, Google Suite, and Slack in order to analyze employee sentiment and engagement. Andrew Fastow has an estimated net worth of $2.5 million. Jeffrey Skilling, the architect of the gas bank, the visionary who turned long-term contracts into castles of paper, was also convicted in 2006. Fraud, conspiracy, accounting manipulation. His initial sentence, 24 years and 4 months. Though years later, he managed to reduce it and was released after serving 12 years in February 2019. In a separate proceeding, he was also barred from serving as a director or officer of a public company. After his release from prison in 2019, Skilling sought to establish a company called Veld LLC, which was purportedly a trading platform to facilitate the trading of natural gas and other energy. And what about Kenneth Lay? Lay was found guilty, but he never set foot in prison. In July 2006, he died of a heart attack while awaiting sentencing. Some mourned him, others didn't. For many, he was the one who allowed it all to happen. Then came Arthur Andersen. The auditing firm was accused of obstruction of justice for destroying evidence related to Enron. In 2002, it was found guilty, lost its license, and collapsed. Thousands of employees around the world were left unemployed. 3 years later, the Supreme Court overturned the conviction on a technicality. But by then, Andersen no longer existed. Meanwhile, civil lawsuits flooded in. Investors, employees, pension funds, everyone wanted to get something back. Some reached settlements, but most lost everything. And in Congress, the Enron scandal set off alarms. It was time to rewrite the rules. That's when a law was born that would forever change how public companies operate in the U.S. The Sarbanes-Oxley Act of 2002. More oversight, more transparency, more accountability for executives and auditors. In the world of business culture, the name Enron became a symbol of excess, greed, and self-deception. If you have any other cases you want me to check out, let me know down in the comments below. Thanks for listening, and be safe out there.